All right, welcome. This is a 10-minute takeover with Steve and James from Parry. We're partners in the tech and high growth team, and we are going to try and do a 10-minute version of international expansion, which is not easy. We did it in 45 minutes on a live audience this week, and it still took Q&A to get through everything. So we're going to try 10 minutes. I'm going to ask James Q&A, and we'll go from there. So, James, where do you start if you are a CFO thinking about international expansion?
Right, so from a CFO's perspective, I think you need to balance it out and look at both the risks and the opportunities that international expansion can bring for your business. Invariably, businesses are going to grow overseas, and therefore taking an approach where you know the pragmatic steps that are required to get there is a necessity for the business. When you're looking at it, break it down into the risks and subsequently the opportunities. So the risks are going overseas, when you're creating, and how do you create a presence overseas? And what that means for the business as a whole, and we'll touch on that today. And then looking at that, aside from that, is what are the opportunities that can be created? Generally looking at that with a lot of the businesses that we're talking to at the moment, if you're a tech business, that will create an abundance of opportunities as you grow overseas.
Yeah. So what's the starting point in terms of saying, like, I'm doing something overseas, but does it really constitute actually needing to create like entities or create structures? Like, what's the trigger point in your mind?
I think the main thing to start with is determining whether you're trading in or you're trading with a country, and they're very different in terms of what they mean for the business. If you're trading with a country, then actively, to be honest, you're only trading with. You've got a contract with that country. Now that doesn't mean that you've got boots on the ground, that you've actually got an office there. You're not actually active within that country, and there needs to be a distinction then when considering if you're trading with or trading in. If you're trading with, you're actively not in country, whereas if you're trading in, you're actually there, boots on the ground, and you're going to create some level of permanence within that country.
Got it. So I hear a lot of people talking about permanent establishments, talking about creating a presence, talking about other sort of buzzwords like that. What's this permanent establishment point all about, and what's your triggers on considering whether you have one?
Yeah, so generally speaking, there are guidelines that determine to what extent you have a presence in country. And whilst there are variances in relation on a country by country basis, generally speaking, there are relatively fixed terms that can be determined. So you create a presence in a country where you've either got a fixed place of business or you've got agency staff operating in the country. Now they're different and distinct. So a fixed place of business generally means that you've got some kind of office, a permanent fixture in country, right? Now, for a lot of tech businesses, that'll generally mean an office. It can extend to a WeWork office as well.
Yeah.
And there has been current case law that would suggest that a home office would also fall within that criteria if certain time limits had been met. So you've got to be careful if you're creating some form of permanency in country. And the second type of permanent establishment is an agency relationship. That's where an individual habitually negotiates and concludes contracts on behalf of, say, the UK business, and as such will trigger some form of permanent establishment in country. And both of those need to be thought through, given the current situation with COVID, which is having an impact as well in terms of where people are being based at the moment.
So if I allow some of my employees to go and work in Spain or France and sit there for 6 to 12 months and work from Spain or France, is that causing me a tax issue?
With all things tax related, you could never give a straight answer, right? But it's one of those things that it is something that needs to be thought through. It needs to be considered. Depending on the level of seniority and what those individuals are doing in country are likely to trigger, a permanent establishment.
Yeah.
There are certain exemptions to that. So generally speaking, anything that is deemed to be proprietary or auxiliary services are not deemed to create permanent establishments. When looking at that, you need to look at that on a case-by-case basis to determine exactly what the relevant individuals are. But as a rule of thumb, anything less than 6 months shouldn't trigger a permanent establishment by way of fixed place of business. That's not the same for agency. You don't have that same level of testing when you've got sales agents overseas.
Yeah. Okay. Cool. So let's just imagine a scenario where we do have a permanent establishment, where we have created and triggered a presence in the country. What's your starting point for, do I need a branch? Do I need a subsidiary? Should I set up now? Do I have what should I do next?
Okay, so generally speaking, there are an abundance of considerations that need to be thought through in terms of, is it a branch? Is it a subsidiary that you need to create? A branch is technically just an extension of the UK business, whereas a subsidiary is a separate legal entity. And as such, you start kind of moving into the world where you start having kind of group structures, subsidiary structures in a group. There are differences for a number of different reasons. Predominantly, the branch, as I said, is an extension of the UK business. It can incorporate and use up losses that are generated overseas, whereas a subsidiary, you can't do that. Now, generally speaking, there are tax reasons why you choose between a sub and a branch, but those are actually overridden more often than not by legal and commercial drivers. So, for instance, your overseas customers, we see this very often with US customers, they often don't want to necessarily engage with the UK business, but actually want to engage in country with a US corp. And as such, that might actually lead itself to you having a US subsidiary as opposed to a branch. And separately to that, a lot of businesses actually make the distinction that having a subsidiary as opposed to a branch creates better legal protection because you have a veil of incorporation between your overseas entity, be that either a sales office, be that a dev center, and actually your UK business, where fundamentally you probably have the most valuable assets of the business sitting there, being either the people or the IP that you're actually generating itself.
Yeah. Okay, so next question is not easy to answer in a few minutes, but I'll have a go anyway. Let's think about a couple of scenarios here where we've got either we've got developers or administrative staff sitting overseas in subsidiary companies or branches, and we've got or we've got salespeople sitting in country in subsidiaries doing and dealing with sales activity. What other considerations are there if you've got those scenarios? Because we talk about transfer pricing, people talk about the complexities of transfer pricing, but what's the starting point once you have those types of activities, those sort of two types of activities? What's the starting point there?
Okay, fine. I think so. I would always start by looking at what is the activity that's being undertaken in country, right? So actually understanding what the relevant individuals are doing, and that then kind of drives what the pricing of that would look like. So technically what the transfer pricing mechanism would look like. Now that looks like from both a UK perspective and from an overseas perspective. Fundamentally what we're looking at here is, if you've gone into country and you have a presence, what would the overseas tax authorities consider to be an arm's length kind of profit margin or charge that would be appropriate? Now, they're different and they're distinct, and they're depending on what activity is being undertaken will determine to what extent that pricing metric looks like. So, for instance, if you have back office support, you've got dev centers, you'd price that very differently to if you've got a sales operation. Generally speaking, if you've got back office support, it would be considered that some level of kind of profit, that some kind of cost plus mechanism would be appropriate. Yeah. Whereas if you're looking at sales kind of reps working overseas, then cost plus isn't a useful metric for determining a profit margin for those guys, and therefore you look at some kind of commission base. You look at some kind of revenue split in terms of determining exactly what an appropriate charge would look like, and that's reflected from both a UK perspective and the overseas perspective as well. It's just worth having a blanket comment there, which is there are SME exemptions for transfer pricing in the UK. However, that does and yes, we're talking to a lot of SMEs about what transfer pricing looks like. What we're saying here is that actually to determine what the relevant kind of profit margin is, or actually how to account for the overseas entity, there is some level of consideration in relation to what the mechanics of that kind of profit or loss needs to look like. And or that needs to be thought through. This isn't kind of when we talk about transfer pricing in this regard, we're not talking about reams of paperwork. We're not talking about local and master files. We're talking about pragmatic steps to create internal documentation that would be robust, both from a tax authority's perspective, but also when considering what a future diligence exercise might look like as well.
Yeah, so making it easy to scale, making it easy to have documentation in place to prove you've actually thought it through. On IP, we've come across the situation of IP being developed potentially, or at least there being development activity in relation to IP overseas, and obviously that might interact with an R&D claim in the UK. Can you just talk a little bit to how IP development overseas and R&D works? Yeah,
absolutely. So quite often with the businesses that we're talking to, they will have dev centres based outside of the UK, more for commercial reasons than anything else, to do with kind of costing of overseas workforce, and availability of staff as well plays into that. So quite often our staff have, our clients have staff either in Europe or in the Far East. And therefore there needs to be some consideration. Generally speaking, you would have already triggered a permanent establishment by having some form of presence in said country, mainly through that fixed place of business rather than the agency, just to take that into account again. And therefore you probably created some form of subsidiary, taking that into account. One of the things that really needs to be considered from a UK perspective is actually how do we ensure that the IP that's developed in the overseas country through the overseas subsidiary is fundamentally both legally and beneficially owned here in the UK. Now that's relatively easy to determine, and is done making sure that you've got tight legal agreements put in place between the subsidiary and the UK entity to ensure that actually that the subsidiary is developing the technology on behalf of the parent, for instance.
Yeah. Yeah.
Now that's useful from a protective perspective. There's no, by creating the legal structure, what you fundamentally are doing is ensuring that the IP is in the UK, which is where you want it to be. We're assuming, but also, as you said, by having the cost sitting in the UK P&L, it means that you're able to enhance the R&D activity when you're making R&D claims. And it's worth worth saying as well that there's also the availability that if you are able to do that, there is an ability to move away from the 65% restriction that normally applies to subcontractors by making a kind of joint election between yourself and the subsidiary, which can increase the costings that are permitted when thinking about the eligible the qualifying expenditure from an R&D perspective.
Yeah, okay. So a couple of last points to finish. One is on repatriation. So business has developed in country, transfer pricing policies in place, but there are profits and cash available in that subsidiary to be repatriated to the UK. What's the thinking there, and how do we make that work?
Okay, so there's a number of things that we haven't touched on today, just given timings. But generally speaking, when you're looking at what costings are going to flow between, say, your UK entity and the overseas one, you probably need to think about IP. You probably need to think about how you finance that by kind of either capital or loans. You probably need to think about any people also that you're going to use, and any central costs actually from the UK entity. Consequently, then there's going to be a recharge, or there's going to be a kind of a repatriation of those costings back, and those are generally through payment of management charges, through dividends, interest, and royalties. The main area that needs to be considered at that point is to what extent any withholding tax would be applicable between the relevant countries, and ensuring that any means that are required in terms of reducing those have been adhered to ensure there's no overall tax leakage. Generally speaking, with loss-making UK businesses, if they're continuing to develop their technology, there is the possibility of tax leakage there between on withholding tax elements. So it does need to be thought through and considered more widely.
Cool. One further point, another buzzword: residency. We've seen instances, particularly during COVID, of people effectively hiring people anywhere. and particularly actually senior people being hired in other countries, like C-level being hired in other countries. So what's your considerations there, and how do you see the risks?
Okay, so the majority of this discussion so far has been around PE and creating PEs overseas. The other consideration is about residency. Now, generally speaking, a UK company is a UK resident by virtue of the fact that it's both incorporated and centrally managed and controlled here in the UK. Okay, now what we have seen in the past is if you have senior members of staff overseas, then actually they can change the residency of an entity by virtue of the fact that it's not centrally managed and effectively managed in the UK. More often than not, it's easier to think through from a subsidiary perspective. So quite often you might have a US subsidiary, and if you can determine that, so for instance, the US subsidiary. If the US subsidiary doesn't have a separate board, it doesn't have its own kind of autonomy in terms of making its decisions, it doesn't have its own board constitution, then it's relatively easy for the UK government to argue, or the UK tax authorities to argue that actually that US entity is centrally managed and controlled here in the UK. Now, that's a situation that you don't particularly want to get into. It creates or it opens up the opportunity for either dual resident or a UK resident business, which fundamentally you want to avoid. And there are relatively simple guidelines that can be put in place to avoid that. So when you're thinking about overseas, I think residency is something that definitely needs to be thought through in more detail as well.
Cool. Just as a final reflection to wrap, it sounds like knowing the trigger events and knowing the boundaries of the rules is going to make a big difference if you're starting to explore overseas expansion or you're already in country in other places. But what's your final takeaway in terms of what people should be doing if they're exploring this?
I think, to be honest, we've only touched on a tiny area when it comes to talking about international tax today, and there's probably an abundance of things that need to be thought through. The key takeaway here is really to actually reach out, have a conversation with your advisors before you go into country, so that you can actually plan in terms of the next steps, making sure that you've got a pragmatic, a proportionate, and a scalable outcome in terms of what you want to achieve. That would be my main takeaway.
And one point on fundraising, because I know most of our clients are fundraising like every 12, 18 months. How does this play into the whole fundraising cycle, and what's your experience there?
I think, generally speaking, for a lot of tech businesses, this is when the questions get asked, right? When it's under diligence. It came up during the discussions this week on the one-to-ones that actually quite a lot of businesses don't even know that there are issues from an international perspective until someone's going through it with a fine-tooth comb on a Series A, Series B, and therefore that's a really important point. Think about it earlier, know what the triggers are, and really do pick up the phone to the advisors and have a chat.
All right, thanks, James. That wasn't quite 10 minutes, so bit of a fail on the 10-minute challenge, but it was a lot to cover. We did get through a lot. Next time, I'm going to do 10 minutes on R&D, and we'll see if you can get from however many minutes this is to 10 minutes. See you next time.
See you later.